Welcome to the Alpha Vee Solutions summary discussion about a popular core allocation strategy topic. Fundamental-driven variable portfolio allocations using US Treasuries can offer several potential benefits compared to traditional rigid 60/40 allocation models. Risk-managed strategies provide advisors with greater flexibility and logical risk management in their investment models. Let's discuss in more detail. Tailored risk management. One of the key advantages of variable portfolio hedging with US Treasuries is the ability to tailor the level of allocation based on market conditions and risk appetite. In a rigid fixed 60/40 allocation, the exposure to equities and bonds remains constant, leaving the portfolio more susceptible to market volatility. However, with variable allocations, advisors can dynamically adjust their exposure to US Treasuries that seek to protect against downside risks during market downturns and participate in equity upside during bull markets. Diversification benefits. While a fixed rigid 60/40 allocation does offer some level of diversification between equities and bonds, it might not be sufficient during extreme market events. By incorporating US Treasuries into the variable allocation strategy, investors gain an additional layer of diversification as Treasuries tend to perform well during flight to safety events when equities falter. Capital preservation. Variable portfolio allocation with US Treasuries can help preserve capital during market downturns. When equity markets experience significant declines, the value of US Treasuries often rises, acting as a buffer against losses. This preservation of capital can offer a sense of security to investors during turbulent times. Enhanced returns. While the primary purpose of variable allocation is to protect the portfolio, it can also enhance overall returns. By actively managing the allocation to US Treasuries, investors have the potential to capture more significant returns from equities during periods of economic growth while still mitigating the risk of major losses. Adaptability to changing market conditions. Markets are dynamic and can shift rapidly. A fixed 60/40 allocation might not be well suited to handle varying economic conditions and interest rate environments. In contrast, variable portfolio allocations allows for adjustments as market conditions change, ensuring the portfolio remains resilient and responsive to the prevailing economic landscape. Lower volatility. By employing variable allocation with US Treasuries, the overall portfolio volatility can be reduced. This can be particularly beneficial for risk-averse investors or those approaching retirement, as it helps smooth out returns and offers more stable long-term performance. Let's look at these two different approaches over a few time periods. For the period beginning in 2007 and ending in 2011. In gold, we see the S&P 500 total return for reference. In red, the Alpha Vee risk-managed US enhanced equity using variable risk management. In green, the Vanguard Balanced Index Fund, and finally, in blue, the BlackRock 60/40 Target Allocation Fund. Now let's look at another 5-year period from 2011 through the end of 2015. And another 5-year period from 2015 through the end of 2019. In conclusion, a risk-managed variable portfolio allocations with US Treasuries seeks to provide advisors with a more dynamic, adaptable, and logical approach to managing risk and returns compared to a fixed rigid 60/40 allocation. The ability to customize hedging levels, diversify across assets, preserve capital, and enhance overall returns makes it an attractive option for those seeking a flexible and effective investment strategy. For more information, contact your Alpha Vee representative at info@alphavee.com.